Welcome to 2019. I don't think it's too late to wish you a happy new year. My name is Lenska with Lenska Realty, and this is the San Diego real estate market update, January 2019. Make it the year you get financially fit. Consider a sprint, which could be a fix and flip, or do the marathon, a cash flow property, or other mailbox money for you. You know, we concentrate on stats, graphs, and numbers. There's no fortune telling here. There's only fortune building. Yes, I offer real estate services for investors and buyers and sellers. I offer flat fee listings. I also do educational events, which you find on Meetup. I also serve on the board of SDCIA. And don't forget to subscribe to this channel so you get the hottest and latest market updates. And I always say, if you like it, then you should have put an offer on it. Contact me. In order to assess a real estate market, we concentrate on the following real estate data points: sales and inventory numbers, interest rates, employment data, home purchasing sentiment by Fannie Mae, home builder sentiment, affordability, NODs, and trustees. Let's dive into it. How did we finish 2018? We finished at the median sales price of $630,000, which was just merely up a 3.3% year-over-year increase for detached homes. The attached units didn't do much better either. There was a 3.1% year-over-year increase of 417,750. But compared to where we were in 2006, we still are higher than at the last point in 2006. Now, we always go by price per square foot, and this is kind of the benchmark how we evaluate properties. And if we look at the average price per square foot of $389, which is for detached, it's only a 2.1 increase year over year. The attached units had an increase of 4.5% year over year, up to 416. So if we can say there was a winner overall, we could maybe say the attached units were still faring better in appreciation than detached. Now, when we talk about inventory, we definitely all have felt that the inventory has increased. It increased 30%, such a low of we were down to 2,800, that any increase is kind of magnified. But we're still not at our 6 months inventory, which is considered a healthy market. So the market will still continue to talk about the low inventory. Active listings, to my surprise a little bit, is up 56%, up to 1,883 units. And you can see this is the highest that we have seen probably until the mid of 2015, which means about 2.5 years ago. Average market time, it is seasonal, and market time always goes up during the holiday season, which is about 20%, and it is about 43 days. Now, we always talk about if the inventory increases, but the pending home sales increase, that's not as bad. But right now we're looking at inventory increases, and we've been looking at pending sales going down. going down in San Diego, California, United States wide. So this is a United States wide graph, which kind of adjusts the pending sales to the population growth. Since the US population grew by about 16%, we would think we're selling more houses and pending home sales would increase, especially since we're talking about more household formations. But the numbers show different, that pending sales are down 18% from 2015, and adjusted for the population, they're actually down by 26% on 2005, right here, when the market was super hot. Again, we don't fortune tell here. These are the hardcore numbers. But there is light at the end of the tunnel, because the interest rate dipped down January 7th, about 4.25%, and for the FHA VA was it at 3.8, which is still super affordable. We even saw an improvement on the interest rate in the 24 months bank statement, which is for self-employed, like us investors, real estate professionals. As we all heard, the December unemployment rate was very good. It creeped up US-wide a little bit, 0.2% to 4%, but San Diego had a very strong unemployment, 2.8%. We added jobs, especially you can see in Carlsbad, Rancho Penasquitos, Carmel Valley, where we have technology jobs and biotech jobs. Home builder sentiment was now a whole different story, because nationally we saw it drop down to 56 points, and in the West we were at 65, still better than nationally. But if you're looking how we started the year, we started it at 86%. That means we had a 20% year-over-year drop. We kind of are out of the lumber price increases. Actually, lumber prices went down, but there's still a shortage of labor and a little bit more of regulatory difficulties. And as we know, it takes 5 years for a subdivision in California, where it takes 5 months in Indiana to get that through. But we also a slowdown in open house traffic, and if you have a fixer fixed up already on the market, you probably felt it too. Now we're looking at the HPSI, which is the Home Purchase Sentiment Index by Fannie Mae. This index shows us how people feel about the real estate market. Are they optimistic or more pessimistic? And that index is a combination of several questions. Is it a good time to buy? Good time to sell? Do you think prices go up? Mortgage prices go up or down? And how do you feel about your job? Let's take a look. Sorry guys, again, bad news. It's the HPSI continues a downward trend since June. We had a little bit of an uptick in November, but otherwise we're practically down another 2.5 points, which is down overall from 86. So we're talking about 5-6 points down. So I would say this is pretty pessimistic. Now, do we know why? Oh yeah, my favorite graph. We all know we're feeling it right here. Is it a good time to buy? It's down 12%. Year over year, it's down 13. Okay, so home prices will go up. Obviously, less people think that way. Mortgage rates, people are in a wait and see period here. and will also feel that very secure in their jobs. But remember, this is always my pet peeve. The people don't report it that they don't will make more money or have made more money in the last 12 months. And if we don't make more money, we can qualify for a house and a house price that seems to be appreciating by 3.3%. Also, Fannie Mae has a question if people feel the economy is on the right track. And as you guys can see, this gap is narrowing. So the net share who says that it's on the wrong track rose 3%, points to 40, and feeling on the right track is also down. Why would that be? Yeah, maybe because salaries are not increasing and inflation is creeping up. So there it is. Our purchasing power is diminishing. If you're looking at adjusted for inflation, it's not much of an increase. Nominal speaking, yes. So I wanted to dissect it a little bit to give you some help to maybe on which inventory class to concentrate and to find out where the profits are. So we always talk about millennials and baby boomers, and here we are. So these are the incomes. When you look at the 45 to 50, or that income hasn't recovered. So maybe that class is not the right way. Look at this one, 65 and older. Yeah, because they probably have most of their money in the stock market, and the stock market is performing well, really, really well. Now, where are those people moving? This is the big question. Let me tell you, I tell you that they're not moving into San Diego. There's a lot more inventory listed in the 55 plus communities. Now, when you're looking at the 35 to 44, the green line, so they making a little bit more money than in the 2000s. Now, red line is the 25 to 35 millennials. They're not doing good. So here we go. That's where we see also an increase in the lower end of the market. But look at the 15 to 24-year-olds, the techies. They had a very healthy increase, and we do see a very young home buyer. But what inventory would they like? I'll let you know in the next market update, February. Medium home price since 1963. I just wanted to make a point to go back to my affordability question. Remember, that was all manufactured with really great loan pricing. So now we are up and we're all qualified at our, the loans are all qualified. So we don't have that, but we still have that. So if you draw that line right here, and you guys can see that we had not a big run up here and then it shot up, but we dove. So if you draw that line right here, so we could actually come down a little bit. And as we know, all markets, and especially the real estate market, is a cyclical market. They always have been going up and going down. The question is just how far down and when. And has it started yet? Again, has it started yet? Are people and future home buyers are able to save money for a down payment? And that, by the way, is the #1 reason why people are not buying a house, because we need 20% down. And if people are paying nearly 30% more of rent of their income, then how can they save up for a house? For the first time in history, Los Angeles has a lower affordability, 22%, than San Diego overall, which means to qualify for the median home price, we're looking to make nearly $140,000. So, where are still the affordable houses? And it's usually indicated by where is it a good place to fix and flip. And you can see Las Vegas, Phoenix, Orlando, Florida, Charlotte, Houston, Texas, even so also their appreciation has been going down. By the way, Las Vegas was one of the best appreciating markets in 2018. So if you're available, go there and profit in these markets. That was January's market update. Let's recap that it was not all bad news, that maybe the decrease in demand and combined with a lower interest rate will spur up a little bit more, a few more buyers and make sellers aware that they have to lower their prices and get those sellers motivated. If you have more education, I'm offering a rehab field trip where we go out to other investors, fix and flips, and analyze properties for deal or no deal and maximum profits. We meet third Saturday of every month. Or if you like more the dinner version, we have a real estate profit building 1.0 where we explore several subjects and topics on real estate, and we meet Wednesdays, first Wednesday of every month. If you find us a meetup, or if you're interested in buying or selling or get financially fit this year, give me a call.